Hello, hello. Well, welcome everybody to our session this morning. And my name is Felicia Lee, and I'm thrilled to have you here. And welcome to this webinar on what we're calling Partners in Practice, where we're going to dive a bit deeper into how to share healthcare business ownership. And so I'm excited to have Jacqueline Flett with us from Breakwater Law and Dat Wong from DW and Company. And so we're going to go into the different areas of planning for a healthcare practice. And specifically, if you have business partners, this is the webinar and the masterclass for you here. So without further ado, we're going to launch into things. And just to give you a bit of an idea of the structure, each of us will take about 15 minutes or so to share, from the legal, from the accounting, from the financial perspective. And you are very welcome, as you have questions, to please feel free to put it in the chat. And we'll be monitoring the chat, and we'll likely answer all the questions at the end of the session, so that we can keep the flow going. But there'll be about a 15-minute to 20 minutes time at the end of our session here where you can actually ask some questions. And we're also going to record this, and following the webinar, we'll also be sending out some resources to you as well, just to give you more resources to follow up on if you would like. And so without further ado, let me welcome Dat first. And so Dat from DW and Company, who is an accountant that we work with very closely, and that has worked a lot with different healthcare practitioners. So Dat, why don't you take it away from here?
Great. Thank you. Thank you, Felicia. So I'm going to share my screen here with everybody. So let me know if you have any problems seeing everything. So so that looks good. We'll get started here. I hope everybody's doing well. I know we've had some crazy weather in the last couple of days, and hopefully everybody is safe. And thank you for joining us this morning. So today we're going to talk about structuring your business through accounting and tax. We only have 20 minutes, 15 to 20 minutes this morning, so we're not going to go super in depth into everything. However, I'm hoping that what I share with you this morning, you'll be able to take some pointers away and go back to your businesses and maybe be able to implement some of these improvements into your business. Okay. So I'm just going to share a little bit about myself. My name is Dat Wong. I am a CPA, graduated from the University of British Columbia with a Bachelor's of Commerce, majoring in accounting. I then went and worked or articled with a small to medium-sized accounting firm located in Vancouver. And I've had over 20 years of accounting experience. Some of that experience has been in public practice, and some of that has been in the industries of banking, mining, and software. In 2010, I decided to leave the mining industry and start my own accounting practice, which is called DW and Company. So we've been almost around for 25 or 15 years, sorry, now. And we work with small to medium-sized businesses, and many of them are in the healthcare industry. We provide tax, bookkeeping, and advisory services, but we do not do any auditing or review engagements. So let's get into the discussion today. We'll start that off with taking a look at the three different types of business entities. In Canada, there are three main types of business entities: sole proprietorships, partnerships, and corporations. And these three business entities make up roughly around 85% of all businesses in Canada. Now, there are other businesses, of course, there's nonprofits, there's charities, there's limited business structures. Those exist as well too, but these are the three main types. And today we're going to focus, we'll touch base on the sole proprietorship and the partnership, but we're going to focus more on the corporation today, given that a lot of healthcare businesses are incorporated. So we're going to talk a little bit more about that today. So let's start with the sole proprietorship. Many businesses start off as a sole proprietorship. It's the easiest and fastest way to get started when you're starting a business. There's not a lot of barriers to entry for this. In terms of legal status, the Canada Revenue Agency, or CRA, they see the business owner and the business as one entity. So you're not considered a separate legal entity. You're considered as one. And so the control of the business entity is based on the owner. The owner has total control over the sole proprietorship. And the profits are paid directly to the owner in every calendar year. So if you make any profits in any calendar year, there's no way for you to defer any of those profits. You must report that in the calendar year in which your business incurred the profit. In terms of debts, you have unlimited liability in terms of the debts because you can get into as many loans and as many debt structures as your company or other people will allow you to. And therefore, you as the owner, sole owner of the company is liable for all of those debts. In terms of taxation, you are required as a person in Canada to file a personal tax return. And as a sole proprietor, you will also report your business in the T1 personal return as well too. That is generally called a T2125 business schedule. And that is a schedule that either yourself or your accountant will also do. And then that is submitted along with your personal tax return. And in terms of the assets are wholly controlled and owned by the proprietor. For a partnership, it's usually more than one business owner. And the partners in the business, same thing, they exist as one legal entity and they're not considered separate. The control of the partnership is determined by the partnership agreement. Generally, a partnership agreement is done up by a lawyer, and it spells out the distribution of the profits, who gets control of it, how are the debts handled when the partners in the business take on any debt. And in terms of the taxation, same thing as a sole proprietor, it is done along with your personal tax return. And the same schedule is done. It's just that you are responsible to report the share of the business that you are responsible for. And the assets of the partnership are governed by the partnership agreement. So this partnership agreement is really important because it does spell out a lot of different aspects of the business and the responsibilities of each partner of the business. Corporations. Corporations are different from sole proprietors and partnerships in many different ways. The biggest difference is that they are a separate legal entity from the shareholders. When business partners come together and they form a corporation, each partner is considered a shareholder in the corporation. So the corporation could have one shareholder or it could have a lot of shareholders. It all depends. The profits that are earned inside the corporation are kept inside the corporation unless the shareholders vote and decide to distribute those profits as dividends to each of the shareholder. Or they might say that they don't want to distribute any of the profits and they want to keep those profits reinvested inside the corporation. The debts are generally paid by the corporation unless the shareholders personally guarantee any loans or any borrowings. Then the shareholders are also liable for the debts. In terms of taxation, there's an additional tax return that is done, which is called a T2, and that's a corporate tax return. So along with filing a personal tax return, you are also responsible for filing a corporate tax return as well too. And the taxes are paid separately from the directors and the shareholders. Lastly, the assets. There's no specific claims to the assets in general because usually the shareholders are given the assets after all the liabilities are paid. And that is controlled and owned by the corporation and distributed at the corporation at the time when the corporation is either sold or the corporation is starting to close. Then at that time, the assets are then distributed accordingly. Okay, so as we delve a little bit more into corporations, when you're setting up your corporation, there's definitely ways that you can do that. You can do it yourself for sure. There's a website that you can go to in BC that will help you set up a corporation and you can do it yourself. Generally, though, if you are a healthcare practitioner, I normally recommend that you go seek out a lawyer to help you with the incorporation because there's a lot of different aspects that need to be considered when you're setting up the corporation. especially if you are a healthcare practitioner that has a college, like a college of physiotherapists or doctors, nurses, things like that. You want to check with your college first because there are rules that need to be considered when you're setting up your corporation as a healthcare practitioner. Um, Also, you want to have the advice of a lawyer, as well as an accountant, of course, but you also want to check out the advice that a lawyer has in terms of setting up the shareholder structure. Now, this is really important because the structure is really important in terms of what your goals are for your corporation, right? And the more flexible the shareholder structure is from the initial setup of the corporation, the better your corporation is going to be 5, 10, 15 years into the business. It's a lot harder for you to change the shareholder structure 10 years into the business if you decide at that point you want to add another shareholder or you want to create a new class of shares, things like that. So it's really good to have that set up at the beginning and make it flexible so that you can add people or sell certain classes of the business as you go along. So that's something that I normally recommend for people. Um, in terms of the classes of shares, you can have as many classes of shares as you want. There's class A, B, C, and each one of those shares have different characteristics. Either you can give them voting rights or non-voting rights. They're either common shares or preferred shares. They have participating or non-participating rights in terms of profit sharing, especially in the preferred shares area. And as well, two things I just want to just mention when you are setting up the corporation is that you want to make sure your articles of incorporation and the central securities register is done correctly. I've had a lot of experience with CRA coming back and challenging some of the articles of incorporation and the central securities register because the structure, although the business owners or the shareholders thought that the structure of the corporation was done one way, but then when we look at the articles of incorporation and the register, it was actually set up in a different way. And they've gotten to some hot water with CRA over that. And in terms of at the end, they were penalized and they had to get that redone later on. So you want to set that up correctly when you're starting your corporation so you can avoid any of those possible obstacles that come your way later on if CRA were to ever challenge any of that. Okay, so let's go into some accounting issues that you may want to think about when you're setting up your corporation. Structuring your financial statements. That's really important, and I don't think enough accountants really do that with their clients. Because a lot of times when you're working with an accountant, generally you get your books ready or your accountant does your bookkeeping and then you give them all the information. They compile everything together and then they issue you a set of financial statements along with a corporate tax return. However, when they're reviewing the financial statements with you, sometimes it doesn't make a lot of sense because generally what accountants will do is they'll do the financial statements for you, but it's structured in a way um, that is done more for the CRA reporting purposes rather than the business owner, what the business owner wants to see. And so they'll sort of merge a lot of accounts together, or they'll just take two or three different chart of accounts and they'll put that all into office expenses or something like that. And so they'll just create one line item for the tax return or for the financial statements at the end of the year. And then when the business owner or the shareholder is looking at that, they're thinking to themselves like, this doesn't give me the information that I'm looking for. So they're not really understanding their financial statements and what their financial statements are telling them. So it's always a good idea to have a conversation with your accountant, especially if your financial statements aren't speaking to you and telling you the story that you're sort of looking for. And so that they can go back and you can work with your accountant to help structure the financial statements in a way that actually makes sense to you and is actually giving you the information that you want to hear and the information that you need so that you can make good business decisions moving forward. Right. And we'll touch base on this a little bit because I do have an example that I'll go through in a little bit with everybody. But yeah, this is really important. The other thing that you want to consider is how are you going to pay yourself? Are you going to pay yourself a dividend or are you going to pay yourself a salary? Right? And this is really important depending on where you are in your life stage, right? If you're somebody that is, maybe getting closer to retirement and you don't, you and your financial advisor, if you're working with a financial advisor, are considering like, oh, do we need to pay ourselves, do I need to pay myself into CPP? Do I really need that? Or do I have enough for retirement? Does salary make sense because I'm no longer contributing into any more RSPs and I don't want more RSP contribution room? So this is a good conversation to have with your accountant and your financial advisor because depending on your life stage or where you want to go with your retirement, dividends and salary does make a difference in terms of what you want to do in terms of paying yourself. Holdings company, some of you may have a holdings company and how to structure that holdings company with the operating company. Sometimes if you're getting close to selling the business, you may want to move some assets up to the holding company. It all depends on what you're looking to do with the business and things like that. So holdings company is something that you want to talk to your accountant about when you do set up a corporation, because it's always easier to do that at the beginning rather than doing that later. Because if you do that later and your operating company is worth a little bit more and there's a lot of assets in there, it generally is a little bit more expensive to move the assets up to the holding company, and there's a lot of work that has to be done from the lawyer and the accountant at that time. Forecasting and budgeting, that's something that I think every business should be doing with their accountant. You want to make sure that you have a budget and forecast in place so that if you're looking to grow your business or wind down your business, you want to make sure that you have the resources allocated in the proper areas of the business, so that that you'll be able to meet whatever obligations you have, especially if you're looking to grow the business, whether or not you're putting enough resources there and whatever's required. And it's good to look at the budgeting and the forecasting throughout the year so you can see if you're like, hey, am I still meeting my goals, right? Am I trending in the right direction for my business for this year? Estate planning is also really important when we're considering um, forming a corporation. Like I mentioned before, you want to have a share structure that's flexible, because if this is a business that you want to pass on to your children later on, or add additional shareholders, or maybe have a family trust in place, then it's good to have that discussion right at the beginning so that, like I mentioned, so that the share structure is flexible and there's not a lot of things that the accountant and the lawyer have to do later on when you want to, or you decide to add a family member or take somebody away. Okay. And the last thing I want to just touch with here is touching base with your accountant. And I think that's really important. I know for our firm, we try to touch base with our clients at least 2 to 3 times a year. Sometimes, seeing your accountant at the end of the year is a little bit too late, especially if you're going through a lot of significant changes in your company. It's always helpful to talk to your accountant and ask them like, what do you think about this? We're taking the business in a different direction, or we're changing the goals of the business halfway through. And they can offer you some advice in terms of how to structure things or how to best handle certain accounting things so that you're not hit with something at the end of the year and suddenly you think, oh my gosh, I didn't even know that this was something that was really important. And so it's always good to touch base with with your accountant during the year. I know one of the things that was huge for this year was the federal government, they implemented the new capital gains inclusion rate, which actually affected a lot of people, especially some of my clients who were getting close to retirement, whether or not they wanted to crystallize or freeze the capital gains that they had so that they could use the 1/2 inclusion rate instead of the 3/4 inclusion rate. And that was a 2/3 inclusion rate, sorry, and that was a big deal for them. So yeah, it's always good to touch base with your accountant so they can bring you up to speed with some of the things that are happening with accounting rule changes and tax rule changes and things like that too. So yeah, so right now we're just going to move into just a really quick example of the things that we look for in terms of what your financial statements are telling you. This is a really simple example, just because we just don't have a lot of time to go really in depth. So when I say what the F, a lot of my clients, they always tell me like, what the financials, what are my financials telling me? And so this is a really easy example, like I mentioned, very simple example, but this was something that one of my clients was actually going through. during their business. My client he was a service company. Obviously, I'm using a fictitious name here, ABC Service Corporation, but his company was growing and they had increased their sales. So we're taking a look at the income statement here. And the income statement showed that his sales increased from 350 to 500,000 during the year, and which is great. You always want to have your sales grow. And he noticed that his cost of services also increased a little bit, but not as much as the sales, which is always a good sign. His expenses also increased during the year because he was growing a business, and his profits increased as well too. So it went from 75 to 108. From a income statement sort of perspective, everything looks pretty good here, right? He's growing his company. His sales are growing at a much faster rate than his expenses, which is great. And his profit was also growing at the end of the year as well too, right? So his income statement for the most part was quite positive. But then we took a look at the balance sheet, right? And so the balance sheet is different from the income statement because the balance sheet really, it gives you a numbers based on what your company is going through over a certain period of time, where a balance sheet just gives you sort of a photo or a snapshot of what your company looks like right now, right? It doesn't give you sort of like what happened over a period of time. So on the balance sheet here, we see that, yeah, between 2023 and 2024, they definitely increased in cash. However, their accounts receivable jumped by a lot, right? And so my client was telling me like, he's suddenly having issues with some of his ability to have cash in order to pay some of his liabilities. And so when we looked at it, we saw that his accounts payable increased as well too, which is way more than what he expected. And so, we went back and we took a look at some of the things that was going on there, and we realized that some of the new clients that he did, he had a lot of really favorable terms in terms of accounts receivable for them, and they weren't able to collect the money as fast as they wanted to. And this had really hurt their company, even though their company was growing, right? He was having some issues being able to pay off some of his bills and stuff like that, and to operate on a monthly basis. And of course, if we go back also to the income statement and we take a look at that, we'll also see that if we treat the expenses as fixed expenses, we'll notice that if we broke that down into a monthly basis, he's looking at $12,000 in monthly expenses. And if we look at this cash, that's more than half of the cash that he had there. So if we were going to take this and spread this out over a several month period, he was going to be able to cover 1 month worth of expenses and liabilities, but not more than 2 or 3 months, which is sort of what you want to know, what you want to have in your bank. You want to have at least 2 or 3 months worth of cash to be able to meet some of your fixed expenses, right? So we went back and we took a look at some of his terms for his accounts receivable. We made some adjustments to that, and also he was able to get some more money up front in terms of some of the services that he was providing. And so this made his cash flow a lot easier, and he was able to meet his obligations better, right? So if we're sort of happy that we caught this halfway through the year, because if we had only touched base with him at the end of the year, sometimes you don't even see your accountant until like maybe 3 or 4 months after your year end, then he could have been into a lot more trouble in terms of his accounts receivable and his cash that he was getting. So yeah, so like I said, this is just a quick example of things that would benefit everybody if they were able to come see their accountant a couple more times during the year, so that you can analyze how your business is going, and your accountant can give you some pointers. Yeah. Okay. So thank you everybody for listening, and that's the end of my presentation this morning. As Felicia mentioned, we're going to save the questions till the end. So yeah, so I'll give it back to Felicia. Thank you.
Thank you so much, Dat. That was very helpful. And now let's pass the baton over to Jacqueline Flett. Jacqueline, I'll have you take it away from here.
Great, thank you. Just going to share my screen here. Thanks so much, Felicia. My name is Jacqueline Flett. I'm a lawyer. I practice out of Victoria, BC. I have been a lawyer for approaching 20 years now, specifically working with small to medium-sized businesses throughout your entire life cycle. It's really my favorite thing in the world when I get to be part of a business from the very beginning, when it's just a brand new bouncing baby business, And then right through to the end where the exit strategy might be winding down, it might be having partners buy it out, it might be a wholesale sale. So that life cycle of a business is, it's really fun to be a part of, and it's really important to keep in mind at all stages. So one of the things I really like to emphasize to my clients is to always be thinking about the end when you're starting from the beginning, which, you know, when you're starting a business can be incredibly tricky because there's so many things to consider. But one of the ways to help businesses do that is through partnership and shareholder agreements. So that spoke a little bit about the different types of structures of businesses, so proprietorship, partnership, shareholders agreement. My presentation specifically focuses on partnerships and shareholder agreements, which is where you have co-owners in your business. So you don't need to worry about it if it's just you and your business. But if you have co-owners, partnership and shareholder agreements, and I'm going to just moving forward, just use the word shareholder agreements, but the application applies to both, can be a really important tool to start with because it flushes out all kinds of important conversation at the beginning before you go too far down the road. So a shareholders agreement is a contract between the owners of the business. So all businesses in BC are regulated. They're regulated by statute, whether it's the Business Corporations Act or the Partnership Act. Healthcare businesses in particular are regulated by their professional governing bodies. But there's lots of gaps in these rules and regulations about how you actually run the business day to day. And this is where a shareholders agreement comes in. It's the agreement between the business and the owners itself about who's going to do what rights do we have, what are our responsibilities, what are our obligations. And they're really important for protecting owners. When you are, you know, investing time and money and effort getting a business on the ground, you want to make sure that it's going to go the way you want it to go and that you're protected for your investment of time and effort and money and reputation, which is really important also. All businesses that have multiple owners, in my opinion, should have a shareholders agreement or a partnership agreement. But healthcare practices do have some industry specific risks above and beyond what other businesses need to have. When you are going through the process of starting up a business, embarking on the conversation of a shareholders agreement is really important for making sure that you and your co-owners or potential co-owners are on the same page. It just flushes out those difficult conversations before you get into business with someone. I've unfortunately very frequently seen people get into businesses with other people and then realize after investing quite a lot of time and money in this business that they weren't really on the same page, that there's some fundamental disagreements about issues or values or goals for the business. One person just wanted to be self-employed. One person wants to build the next national brand. Like when your goals are not on the same page, it creates a lot of conflict. So the practice of creating a shareholders agreement is really useful for flushing all of those conversations out before you get too far down the road. And a lot of times people end up in this sort of, you know, sunk cost fallacy. They've already set up the business, they're already so far down the road, now they're stuck, and it's really hard to get out of because they don't have a shareholders agreement. So the number one issue that I think shareholders agreements should address is dispute resolution. You have to go into business with other people assuming that you're going to have disputes with them. It's just not realistic otherwise. So just start from the basis. I don't care how much you love each other and how much you're on the same page and how much you have the same goals, you will have disputes with one another. So start from that basis and ensure that you have agreement that defines a resolution mechanism for how you're going to resolve that. How are you going to raise issues? Are you going to agree that you're going to use a mediation if it gets bad? Are you going to use an arbitration? Are you going to use a cooling off period? If you create these mechanisms within an agreement, what actually happens is you end up having fewer disputes because when there's a clear process for how you're going to resolve those, it's easier to nip disputes or areas of disagreement in the bud. Where people don't have shareholders agreements in place and they don't have a clear mechanism for how to resolve these, they tend to let little pain points slide. They don't know there's not really a mechanism. How am I going to deal with that? Oh, I'll just suck it up. I'll move on. And so then little issues start to fester until they become big issues because there's not a clear pathway for how to resolve those. So dispute resolution is probably the single most important thing that you need to have in a shareholders agreement. I put an example here of, what if we disagree over who's going to do what? What if we disagree over, we've made $100,000 this year. One of us wants to put it back into the business to help it grow. One of us wants to take that out as profit. How are we going to resolve that? One of us wants to hire a new employee, feels overworked. One of us thinks we can manage it ourselves and wants to save that cost. So creating a mechanism for resolving these issues is really important. A shareholders agreement should always contemplate getting out of the business, and that might be through a voluntary exit or it might be through an involuntary exit. So a voluntary exit is, it's been a great run, I've made all the money, I'm ready to retire now. How can I leave and make sure that I get the value of my business that I've built up without, throwing my co-owners under the bus or destroying the business in the process? But I also really want to make sure I get my money back. Involuntary would be, what if one of your co-owners dies or becomes disabled and can't continue to work in the business? What if they go bankrupt? What if they go through a really nasty divorce and their spouse is claiming an ownership interest in the business? What if they have claims against professional misconduct and their association with the business is creating a reputational risk for the business? So all of these issues, when you're at the beginning stages of setting up a business, people don't really like to think about or don't want to spend too much time thinking about. And you don't need to have all the answers to these things, but you need to have a mechanism for how you're going to address them when they come up. There's nothing worse than being ready to retire and you want an exit out of your business and your partner say, well, too bad. We don't have the money. You can't leave, or if you do leave, you're not getting any money for it. But it's really hard to force that kind of issue if there's not a plan in place. So no one wants to work forever. Everyone wants to leave at some point. Maybe they want to leave and still own it and still be getting dividends, but they don't want to work in it. But just have goals around an exit and ensure that a shareholders agreement is addressing what's going to happen in those situations. My role in this often is working with the business is to ensure that the business will continue no matter what. So partners, owners can come and go, but the business needs to be able to thrive for the benefit of the clients, particularly in healthcare spaces where you have duties to clients for continuity of care and such. And so ensuring that there's mechanisms in place that if someone leaves or if there's a misconduct issue or a death, that the business can continue to function, whether that's by, having really effective terms in an agreement, whether that's by having appropriate key man life insurance. Those are the kind of questions you want to think up front so that you don't invest all your time and money and effort building a business that, gets crushed by an unanticipated departure of one of the owners. I always recommend that people in their shareholders agreements create an agreed upon method for how to value their interest in the business. If you're trying to leave your business, you want to sell out or you've died and the business wants to buy out your estate's interest, getting a chartered business valuator can be really expensive and it can be really time consuming. And there's nothing wrong with doing that. Some people decide that's the best way to get the most accurate value for the business, but it's possible to come up with some other ideas in advance for how you're going to do it. So formulas based on, earnings and revenue over a period of time would be an example. If you can come up with an agreement as to how you will value the business, it will almost certainly save the business and the owners a great deal of money down the road if there's ever an exit event that needs to be dealt with. So it's a little bit of thinking, a little bit of money up front for huge savings down the road, and likely a lot less dispute as well. Shareholders agreement always needs to consider what the financial obligations and the contributions of the owners are going to be. It's really common for people to start up a business and to come up with sort of a startup budget for the business. And the parties to say, okay, we'll each contribute 25,000 or 50,000 and we'll get this off the ground. But you need to have those ongoing conversations. What happens if a big investment is needed down the road, if new equipment is required? What happens if one of the owners has a lot more access to resources than the other owner? Is it fair that an equal demand should be placed on both owners when you know that they don't have the same equal ability to meet that demand? So those kind of conversations are important up front. And they can also, again, help to flesh out where each owner is coming from. So if you're coming at a new business and you've got lots of resources that you can draw upon, you might want to know that the person that you're going into business with doesn't have those same resources and is going to be relying on you really heavily if a cash call is needed. And so that conversation can bring that kind of tricky conversation to the forefront before you get too deep into it. I would say that healthcare practices, more than almost any other business, have issues around protecting the reputation and operations of the business because you do have this regulatory environment that you have to work within, where you have to abide by the rules of your college. You do have reputational risks that can be really damaging to everyone in the business if one person should be, charged with malpractice or things like that. That can be devastating to the value of the entire business. You do need to ensure that there's really clear confidentiality provisions. If you're in the business that handles sensitive patient data, you've got to have practices in place to make sure everyone is on the same page about handling that. It's very common for a lot of businesses, if they have co-owners, to include non-competition provisions. So if one of the owners decides to leave and start up a different practice, that they can't compete or they can't solicit the clients away. But again, in the healthcare industry, that can be a little bit tricky because oftentimes the regulatory body has rules about that it's patient's choice. You can't prevent patients from going with their preferred healthcare provider. So it's very common to need to get advice about that. And it's a competing balance between protecting the value of the business and making sure that you're meeting your regulatory obligations. When I speak to people about doing shareholders and partnership agreements, when there's co-owners in place, almost 99% of the time people are like, yes, we know we need to do that. And yet so commonly people don't do that. And the question is why? The first reason is because the best and easiest time to do it is upfront. You're incorporating your business, you're signing the lease, you're getting things off the ground. That is the time to do it. But there are so many competing priorities when you're in the startup phase of a business. There's so much to think about that it just becomes important but not urgent. And so it gets pushed to the back burner, and then the business gets off the ground, it starts running, and now you're really busy because you're operating the business, and it never becomes a priority until something happens. There's a dispute, there's a death, there's a disability, something happens, and then people go, I wish we'd had a shareholders agreement. But once a dispute's happened, it's too late, because if you can't resolve that dispute, you're never going to be able to resolve getting a shareholders agreement done. So it has to happen before that. A lot of people find standard shareholders agreements to be really too confusing and too complicated, too full of legalese. And I understand that. I think the thing, the good part about that, though, is that 80% of shareholders agreements are basically all the same from each other. It's really that last 20% you have to work out and discuss with your partner and the lawyer in drafting it. So if you look at an agreement, you're like, this is too complicated, too much to think about. The goal is to focus on what are our areas of disagreement. Everything else is, we're in agreement, we checked with a lawyer, we're all in agreement about that. We really just need to resolve these discrete issues. And for most people, those are just a few things. It's not all the things. Most people are in agreement, about all, the majority of the things. Like if we need to, put money into the business, most people agree we'll try and get it from the bank first before we have to put our own funds up. Or if someone dies, most people agree that the the surviving business owner should be allowed to buy out their interest from the estate of the other person. It's rare that people disagree about those things. So it's really just focusing on what are the areas of disagreement. I'm told oftentimes that lawyers say to clients, what do you want to do in this situation? And clients are like, I don't know. The goal, there's a mismatch. Lawyers always want to be told what to do, and clients also want to be told what to do. So I think a really easy solution to that, in my experience, from a client's point of view, is to say to the lawyer, what's normal? Or what have you seen other people do? Lawyers are often reluctant to say, here's what you should do. But they will say, well, here's some examples of other ways I've seen people do it that might work for you. So it's just maybe getting on the right page with the questions that are being asked. The best way to start is just to start. Most lawyers have really good questionnaires. I use myself a sort of a sheet where co-owners can go through it together and they can tick boxes. And any area that the co-owners tick the same, that's easy. We're on the same page. And it's only areas where they tick differently or they write, I don't know, what's normal. Those are the only questions we need to address outside of sort of our normal standard shareholders agreement. But too many people get hung up on the perfection of filling out these questionnaires or their forms instead of just take a stab at it. It's just a starting point for a conversation. Most lawyers, in my experience, will then be able to take that and say, okay, let's work through the areas that we don't have agreement of, or we're confused about, or we're not sure how this would work in reality. So, the goal is not to get a shareholder agreement done right away. The goal is to let's sit down and have a conversation with our questionnaire and make sure me and my co-owner or my partner are on the same page together. And you can baby step it forward from there. But I do really recommend that it happens early on in the conversation whenever you're about to get into business with somebody new. It's very similar to a marriage or another kind of relationship. There's going to be problems, so let's just come up with a plan for how to address them so that they don't become divorces down the road. That was a very quick summary of the why of shareholders agreements, the kind of key issues that you need to have in the shareholders agreement. Primarily, my goal in this is to, if you're considering going into business with another person, multiple people, or you already are, is to encourage people to get a shareholders agreement. It's very similar to a will. Everyone knows you need a will, but so many people don't have them because it's important, but it's not urgent. And the shareholders agreement is the same way until it is urgent. And if it becomes urgent, it's too late at that point. So, don't put it off. And it can be a really great planning tool for the business in helping you guys, chart a course for the goals and where you're hoping the business is going to end up at the end of the day. So, having that conversation at the same time that you're creating a business plan or a 5-year strategic plan or whatnot, it aligns nicely with it. It doesn't need to be a difficult conversation. It's not like you're asking a spouse to sign a prenup the day before the wedding. It's a prudent thing that business people should be doing. And I think I'll stop there. But again, I'm happy to take questions in the chat at the end of the session. And I'll turn it back over to Felicia.
Thanks so much, Jacqueline. And so, those are a lot of questions for us to consider. I'm sure I have a few questions that I'll even check in with you at the Q&A period. Okay, so for now, let me share my screen. I'm gonna jump into the next area to talk about, which is financial planning for healthcare practitioners. And so what I want to cover, we work with a lot of clinic owners and healthcare practitioners. And so what I want to highlight today is just the common financial planning issues that come up and talk about a framework for how to address these issues. And so the first question that perhaps I'll pose is just, why is it so difficult to figure out finances? And so I, kind of through these are all the different areas of planning that you'll probably encounter as a healthcare practitioner. Whether you're looking at growing your practice, you're considering what are my personal financial needs, how much do I pay myself? You're thinking about what does my family need? I'm working on, the accounting and tax planning for my practice, as well as for me personally. And then there's legal, investment, insurance, retirement. In the future, how do I exit from my practice? How do I transfer all the wealth that I've accumulated? Do I how do I send that off to the next generation in a tax effective manner? So it's been very difficult just because there's all these different areas of planning to consider. And there's usually probably an advisor or a specialist that's working for you in each of these area. And they are probably not talking too much to each other because each advisor is working in their lane of expertise. And so, as a healthcare practitioner or an owner, you're often left to be the glue that is, that is holding all of these things together. However, you may have found that it's challenging to translate all the technical language and concepts and how to translate that between the different areas of planning. And so that's what we found to be, that clients have come to us and said that it's been complicated. So at Clarity, we have a process that we designed to incorporate exactly that, the multiple areas of planning and address them in your practice, as well as in your personal and family areas across different stages of business and life. And so whether you're starting your practice to growing it, to planning for exit or retirement, or to transfer wealth to the next generation, these are some of the frameworks that I want to share with you for how to think about it. So the step one, really, for when we think about financial planning for healthcare practitioners, is really starting with your personal financial design. And so what I mean by that is taking a look at, how much do you actually need? What income do you need for healthcare practitioners that are, incorporated, you have the flexibility to, as Dat mentioned, to pay yourself a salary or dividend. And so there is often flexibility, and I often get a question like, I don't know how much to pay myself. Should I pay myself more or less to save taxes, or should I pay myself more? And often you might have an idea, but not super sure on how much you are paying in all of these different areas. I often find that, when we have income coming in, then we have this choice to make, which is how to allocate our income. And so these are the 5 different areas, regardless of how much money you're making. These are the 5 different areas that you can allocate to your personal spending. They are about personal living expenses. So, rent, food, transportation, and all that. How much debt you're repaying, whether you have mortgage or a line of credit or some credit card debt that you're paying off. How much taxes we need to put away to pay. That often we have an idea, but we're not quite sure how much that's needed. And how much should I put away for savings and growing it in the future? And how much, do I have in my heart to maybe support charity and organizations that, where I believe in the cause for. So in addition to that, figuring out this for today, we often also get questions on, well, how do I know how much I'll need in the future? And so if it's 20 years from now, I'm thinking of retiring from my practice, and how do I know how much I need to put away so that I have enough to live on the income? And it's, again, 15, 20 years away. Maybe I'm not even sure what that picture looks like yet, and so it's a bit confusing about how to do this. And so often my suggestion is to, we can have some examples, we can have build scenarios for our clients, and we can often work backwards to see if whatever planning that we're putting into place today is on track with the, with where we want to be in the future. So I would say start with step one is figuring out what your personal financial needs are. And then the second step then is to then go back to the business. Once you know how much you need personally, then we can work backwards to figure out how much your practice or your business needs to generate. So as a prior business coach, this is the area that I really enjoy, which is to work out, right? What is your practice's revenue goals, profit goals, and then how best do you allocate the profit to each year? So here's a bit of a busy picture here, but if you focus on the left side, in the blue side, and so it might be a sole proprietor or partnership, but or a corporation. So if it's in a corporation, right, we're figuring out deciding what are our revenue goals, what are our expenses, and what do we expect profit to be? And that question I often check in with clients. Because once we know how much profit we have, then we can figure out, is it sufficient to cover my personal needs? And one of the areas of planning is also to consider, what do I do with the profit each year in my corporation? Am I going to put it back into the business, into the practice to grow, hire an associate? Am I going to expand to a different location? And or do I want to pay myself more? This is an area that I often find clients are very mean to themselves. Like they don't pay themselves very much. And I said that you are, terrible to your CEO. So you're the owner and you're not paying yourself very much because so much of the resources are invested back into the practice. So that's a question to check on as well, is to, how much do we want to compensate ourselves in order to have a healthy business model that is growing? Because otherwise, I can see that, for someone starting for the first couple of years, maybe you're not paying yourself that much. But over time, I really think that a healthy business model needs to compensate their CEO and the primary care person in the business sufficiently so that if in the future, should you want to retire or have someone come in to run the business, that the business itself actually has a healthy model to pay someone to run it. So this is an important question to think about. And so the other thing is also, for some clients that I work with, something that's come up is how much am I putting away for the future? And so we can assume that we might work in our practice for a long time, but it's always healthy to, I call it harvesting along the way. And so while you are putting some of your resources back into the practice to grow it, I also encourage a lot of my clients to put that away, maybe diversify some of the assets, maybe into investments, so that in the future they have a separate investment portfolio or rental properties, just some other income producing asset that they can use in the future and not just put all their eggs into just the business, because things could change and, you might decide to work or work less in the future. And so the key here is really to be intentional with what we want to see so that we can measure the results against the goals rather than just trying to. Sometimes I find clients when I'm asking them, like, what is your revenue target for next year? And they'll say, oh, I'm increasing it by 10 or 20%. And often the goal might be a bit arbitrary just based on what I think I could do or what I think, my other competitors in the area are growing by this much. And so I want to grow by this much too. And often I find that if we know what we need personally and we have a goal for what we want to see in the future, then we can actually align our business goals and set the strategies and all that to support our personal needs. And after all, I think that's why you run a practice on your own rather than work for someone, because you have an option then to design and to manage and to grow your practice to support the lifestyle and the outcome that you are looking for. So while we're figuring out the business and the personal financial planning side, often where this gets a bit more interesting or can be a little bit complicated is when you have partners. So when you have two or multiple partners, a new sets of questions I find come up. I haven't met anyone who have partners who have exactly the same thought about what they want to see in their practice or even the same goals. We even have a client that and I share a client, where they're actually twins, and they even themselves have different visions and personal needs. And so then, so it's probably likely that you're going to have partners that have different visions and different ideas than you. And so as Jacqueline's talking about shareholder agreement and having this conversation early, often it's we find that, right, like these are some of the questions that have come up. How much are we working? Are we working the same hours, different hours? What are we doing? Are we doing the same type of work, different type of works? And how do we compensate ourselves? I've often found people just by saying, well, we're 50-50 partners, so we pay ourselves 50-50. But then one partner ends up working a lot more than the other partner. And sometimes, a bit of resentment and can come up because of the differences in what we expect to be paid ourselves, how much they're working and how much they're getting paid. So here's a quick example of maybe something to consider is I've seen what some clients do is that you may, structure your compensation to have multiple components. And you may want to, like, if you yourself are seeing patients, and then so you may be paying yourself based on your caseload. If I see more patients, I pay myself more. That's me working as a practitioner in my own company. And so in the future, if I choose not to see patients, then I can hire another practitioner to replace my work, and I don't get paid that caseload billing. That's one option. The other thing is also, are you paying yourself a management fee or a salary for being a manager, the CEO, right? Like you're kind of managing the business and being the manager of the company. So how are you compensating yourself for that? Again, in the future, should you choose not to do that, you may want to hire an office manager to come in and to help you manage the practice. And so then by setting this up according to the job functions, I find that it's a healthy way to reflect how how well the business is running. And you also get to compensate yourself based on the job description. And the third thing is also then, this is more based on ownership, having profit sharing. And so often we see this by, partners deciding what their dividend policy is. And Jacqueline mentioned about this is that, in your shareholder agreement, do we have some policy about how we're going to do profit sharing? How do we know what happens if one person wants to pay themselves more and the other person doesn't? And so often this is a healthy conversation to have. We've seen cases where, one client has a big family, has, 3 or 4 children, and then the other partner is a single person and really doesn't need as much compensation to pay for their own personal financial needs. And so then the question I think often comes up is like, well, I need more money. And so the structure of the company, does it allow you to pay yourselves what you need without the person being upset about like, well, I need more money, but I don't want to pay myself more because then I'll have more taxes. And if I don't need it, I don't want to pay myself more. So again, and Jacqueline also mentioned this earlier, what if one partner wants to grow, one partner wants to slow down and retire? And so a lot of these are conversations that can be had. And often I find that they are, often not, it's hard to have this conversation a bit further down the road. And so sometimes we get brought in as the facilitator to have some of these conversations, and that can help set up some expectations for the practice. And so an example of more picture here, an example of something that you may consider is Dat mentioned earlier about setting up a holdco. What does that look like? And so this is a fairly common planning strategy that we've done, where in the middle of it you have your practice, right? You might have a corporation, a healthcare practitioner corporation, where you run your revenues and expenses and make a profit. And often, if you are just owning this company, just personally, then sometimes there's restrictions about how you pay yourself, because if what you pay one partner, you must also pay the other partner equally if you have equal shares. And so often we have, worked with Dat and Jacqueline to set up holding companies. So here's an example, quick example, just showing you if owner one has holdco, holding company number 1, owner 2 has holding company number 2. And that way you are able to, have conversations about how much profit gets moved from the company, from your active company into the holding company. And then that gives you a bit more flexibility to pay yourself dividends from the holding company as you need. So if I am owner 1 and I'm a single person, I can just keep more of my funds in the holding company 1. I don't need to, pay myself as much dividends. I can just have it in there and save a bit of taxes. Whereas if I'm owner 2 and I have 7 children, then I probably want to, pay myself a little bit more dividends so I can help with some of the personal expenses. So here, this is just a quick example of some of the conversations that we have. It's the key is really about having flexibility, having privacy about how you handle your finances, but then having a structure that supports your personal financial needs, and structuring your business in a way that gives you these flexibility to optimize your tax planning and optimize your financial planning, while giving each partner some independence in terms of what they don't want to do with their money and with their personal planning. So Jacqueline also addressed this as well, is, we often think about growing the practice, and a very important consideration is also, right, what happens if there is some exit, and so to anticipate the exit. So some exits are voluntary, where we can plan for it, and some exits are involuntary. So what happens if a partner is sick or pass away prematurely? And so a question I would often ask clients is, if you are sick and can't work, do you still want to get paid? And so the answer is usually yes. How do I structure that? And how will your partner feel about paying you while you're not working? And so those are right? Good questions to ask. And so how will the practice continue to operate if you're not working? Do we need to bring in a replacement? Is that even possible? And again, if someone is ill or, away on an extended time, is it okay that they stay your partner for a long time if they can't work for 2 years, 3 years? So the shareholder agreements sometimes need to consider that. And so I think those are some important questions that we often also bring up for clients. And so you can, we talked about using a shareholder agreement to anticipate some of these conversations, and there's definitely best practices that Jacqueline can share on, how you structure those and what are some of the things to consider. And the other thing I find that is also, when it comes to financial planning is, do we have money to handle these sort of situations? So if as a partner, I'm ill, I want to pay myself, then where is that money going to come from? Is it going to come from just cash in the practice? I find for most businesses, there's probably not a whole ton of cash that we're just keeping as cash in case something goes wrong. So our options are, if we can't work, but if we need to, continue to run the company, then I can pay it from cash that I have. I can allocate future profits or future earnings to say, well, from now on, and everything that I make, I have to use that to pay out my partner or to keep their shares or to buy out their shares. Or we can use insurance. And so there's different types of insurance that I'm not going to go into here, but there's buy-sell insurance about buying out a partner's shares if they pass away. There is key person insurance if they're an important part of your company, any key person, and if they're ill and if they pass away, we will have funds from the insurance to pay for their salary, pay for a replacement, or overhead, which is this a type of disability insurance that if you can't work, then this insurance will allow you to pay the expenses that your practice has. And so then, buys you a year or two of time while you are recovering and figure out what to do with the business. So those are some important considerations to think about. And so I think in summary, in reality is that there is a list of all the things that we can take a look at. And so we have at Clarity Planning developed something called Financially Smart Business Frameworks that takes a look at all these different areas and gives you a comprehensive checklist of things to think about. So we probably start from the bottom, a chat about what's the vision that you have for your business, because all your financial planning strategies should align to the vision that you have for your business. What does the sum of the ownership policy look like? How do we pay dividends? How do we bring in people into our practice? How do we exit people from our practice? What does our cash flow look like? How does our margin look like? What does our profitability look like? And then have we provided enough protection? So that's under the provision areas, just to take care of things that are unpredictable that may come up. How's our cash flow going? So these are all the different planning areas that are involved. But I think more importantly, it's just about having the right team of advisors. And you probably will find that as your practice grows or changes, that you need to start to have different, advisors working with you. And so do we have the right team of advisors? And that mentioned a little bit earlier about there are some accountants where their job is just to file your taxes, and then you don't really see them again until the next year. So as your business grows, you probably will need a different set of advisors. And so we often see clients seeking advisors that are more proactive about helping them do forecasting, budgeting, being proactive about, the planning, setting up shareholder agreements, having the right contracts in place. And so then you are looking more for advisors rather than just order takers in a way, right? With the specialists that are supporting you. So we do have an assessment called financiallysmartbusiness.com that you can visit, and that will give you a whole checklist that you can just check off, and it'll give you a report on specifically for your practice where, what are some areas that may be gaps or opportunities for you to consider. And so I think that at the end of the day, there's probably a lot of different people that you need as your practice grows to support you. And the key is to consider, who's going to be the lead advisor to integrate with all your other advisors and bring everyone to the table. And very commonly we see for example, needing a lawyer, an accountant, and financial advisor, insurance advisor, investment advisor. And so I think it's helpful to consider, right, how that process will work and how you integrate all the pieces together. So that's something to think about. So I'll probably end the presentation there. And so then I think that we have a couple of resources that are available for you. But the next steps is, consider, well, first of all, thank you for coming today. And if you, perhaps consider with your practice, what area comes up for you that you feel, this is the next priority for me to work on, and then determine if you would like to start or, optimize your planning so that you can benefit from the benefits of really owning a practice. And so we're going to have different ways for you to connect with us. We'll send out an email with some resources and with contacts for Jacqueline and for Dat to connect with you. And so you're able to book a time if you have some specific questions to check in with them. But now I'll wrap it up there, and I will maybe now we can take questions.